Now another thing would be that if I change the loan repayment schedule from equal to annual amortization, it should balance. Again, if I change the tenure, it should balance. And if I change it to, let's say, bullet repayment, it should still balance. If I change it to 7, it should still balance. If I change in future years the target debt to assets ratio to 0%, it should still balance. Most students learn debt schedule as a simple formula, but that's just not it in corporates. In real corporate finance models, the challenge is not building the debt schedule, but the challenge is building it dynamic. For example, if I change the loan tenure from here from 3 to 6, the model should adjust. Or if I change it to 9, the model should adjust. If I change it to 10, it should adjust. Now another thing would be that if I change the loan repayment schedule from equal to annual amortization, it should balance. Again, if I change the tenure, it should balance. And this debt schedule in front of you, I believe, is the least that you should know version. There are further advanced versions as well, but this is the least version that you should know if you are going to work in a finance profile. In this video, I will show you how to build this kind of a flexible and a dynamic debt schedule. We will first start with the understanding of concept of why to build debt schedules, and then we will move on to how to effectively build a dynamic debt schedule. And then finally we will move on to understanding the impact on income statement, balance sheet and cash flow. Now let's start with the first part of the video, which is understanding what is a debt schedule. So a debt schedule will have mainly opening debt balance, and then new borrowings, and then principal repayments, and then the interest expense and the closing debt balance. Interest expense is not the part of the debt schedule, but it is generally captured just below the debt schedule. Now the primary purpose of debt schedule is to correctly reflect the relevant transactions that would occur across income statement, balance sheet and cash flow statement. Now analysts build debt schedules mainly because it helps them forecast interest expenses, it helps them forecast the debt balances, and it also helps them assess leverage, and it also helps them evaluate the covenants compliance, and also to determine the enterprise value and equity value. Now let's move on to the type of debt repayment methods. So here I have tried to list out the 4 most important debt repayment methodologies. First is equal repayment, wherein the principal is repaid equally throughout the loan tenure. It can be equal monthly, it can be equal half yearly, equal quarterly or equal annually. The second one is the bullet payment. Mainly in bullet payment, either most or the full principal will be repaid at maturity towards the end of the loan. In sculpted payments, the repayments are generally linked to the cash flow generation ability, and especially they can differ across the years. If you ever come across on how to model sculpted loan repayment methods, just have an input schedule for across the years for which can be changed, like year 1 15%, year 2 25%, year 3 30%, like that, and that percentage numbers will represent the principal repayment across those years. And then finally the last one is annual amortization. In annual amortization, the total payment remains constant across the years, and initially the interest would be higher in the initial periods, principal would be lower, and whereas you move forward in the loan tenure, the interest component reduces and the principal component increases. It's generally the same concept as equated monthly installments, EMI. Now let's move on to the second part, how to effectively model a dynamic debt schedule. So first thing, we have listed our assumptions here. The first assumption is that we are assuming capex additions across the year, and we have debt raised. Now the debt raised is dependent upon the target debt assets ratio, which is again a dynamic number, and the user can change the target debt assets ratio. This becomes very much helpful when you are changing your assumptions for future years. So always model your new debt raised on the basis of target debt to assets ratio. Second point, the remaining part of the capex additions which is not being funded via debt would be funded by equity infusion, whether it is through internal accruals or it is via external equity infusion. So that's what is being calculated here. Now interest rate, that's the assumption that we have taken of 9.5%, and this is the target debt assets ratio. Loan tenure. Loan tenure is assumed at 7 initially. So here what I have done is that I have given a flexibility from 2 years to 10 years loan tenure term. Now for instance, if someone enters 11 years, this will throw an error. So that's what I have done is that I have given a fixed range, but that the numbers can only be entered from 2 to 10 years. Now repayment methodology, this is a data list where user can select what kind of debt repayment methodology they want to go for, and it's just an option that you can select. And this becomes very much helpful when you are negotiating debt raise with the bankers, especially when you are part of corporate finance team. And then this is just the bullet payment assumption as to how much percentage would be paid in last year, and this should not be more than 100%. And this represents the percentage that would be paid in the last year, and the remaining percentage of loan would be repaid across the remaining years. Now let's move on to the debt schedule. So for debt schedule, we start with opening balance 0, assuming that there was no previous debt balance. For additions, we have linked it with the debt raised. Let me just make this as 60% so that we can see some numbers here. So this is the additions to loan. So 57.9, 40.3 and 49.17. These are the new loan additions. And after that we have loan repayments. We will come back to loan repayments. So these will be the loan repayments, and then you will have the ending balance, which is the summation of all of these three. Now let's look at how the interest expense is modeled. Interest expense is just simply interest rate into your sum of opening and additions, and this way we will get the interest expense that is applicable. Now the only missing piece is the loan repayments. Let's look at that and our debt schedule would be fully done. And this is the most important part of how to model loan repayments correctly. If you see that this is basically taking the numbers from here. Now essentially see the loan, there are 3 loans being raised in individual years. So basically that's why I have captured here as tranche 1, tranche 2, tranche 3. Ideally it's always better to color code these slightly differently so that it is easier to distinguish them. Now total payment is just the summation of all of these 3 tranches. First tranche, if you see, simple ifs, multiple ifs function, which says that if this is equal to annual amortization, then you give me this. Else if this is equal to bullet, then you give me this, which is the bullet payment here. And if this is equal to equal, then you give me this equal. So basically the 3 types of principal payment methodologies are modeled here for each tranches. Now let's look at how we have modeled this. This is the best way to model annual loan amortization. So there are 3 functions: PPMT, PMT and IPMT. IPMT stands for interest payments, PPMT stands for principal prepayments, and PMT stands for total payments, which is PPMT plus IPMT. So we have to calculate principal, so that's why I've used PPMT. I am saying here that if count A of this row is less than or equal to the loan tenure, then you give me PPMT, which says rate is 9.5%, then the period. So the period is this, again it has to move, so this is 1 for this year, it should be 2 for next year, like that. And then number of periods, I have given the number of periods is as 7 because that's the loan tenure, which is again fixed to dynamic moving number. And then the present value, which I have given as the first part of the loan. So this is the tranche 1, and else you give me 0. Now if you see, I've just dragged this formula across, so it remains same for the first tranche. For second tranche, if you see, it's just the second loan. Same thing, same concept, same formula, just the thing is that it starts for the second year, the loan that you will be raising in the second year, and same is dragged across. Now for the tranche 3, same concept. It's for the loan that you have raised in the third year, and continues forward same way. Now this takes care of the annual amortization. Let's look at how bullet repayments are modeled. Now bullet repayments are slightly typical than the annual amortization. So here if you see, the concept is still the same. So here if you see, I have again said if count of this, and it's a fixed to moving variable, is less than C35, which is the loan tenure. Because what I want to do is that in the last year give me 90% and the remaining 10% you spread it across the previous years until n-1, which n stands for loan tenure. So if the count is less than 7, then you give me 1 minus C37, which is this, divided by C35 minus 1, which is this minus 1. So 1 minus 90%, which gives me 10%, divided by 7 minus 1, which is 6, into the first loan tranche. If this is not the case, meaning then if that is equal to the last year, so that's why I've said if this is equal to C35, which is the last year, 7th count, then you give me 90% into the loan amount. That's what is happening. And same formula I've dragged it across. And same thing for tranche 2, the only difference being that the second year loan comes into play. And for tranche 3, same formula, again the only difference being that the third year's loan comes into play. And again these are dragged over. Now let's look at the last part, which is the equal repayment part. This is very simple, but concept is still the same. If counting of this to this is less than or equal to 7, then you give me the loan raised in the first year divided by the loan tenure, else you give me 0. So here I have dragged this formula and I get these values, and the moment 7 are done, it starts giving me 0. So same thing for tranche 2. The only change being here is the loan that is raised in the second year. And again I have dragged the formula. For tranche 3, I have taken the third year loan and then I have dragged it across the years. Now when individual these three are modeled, then most of the work is done. The only thing remaining is to make a choice based on the user selection. So here that is what I have done. So if the selection is annual amortization, you give me this. If the selection is bullet, you give me this. And if the selection is equal, you give me this. And these formulas are dragged across for tranche 1, then same for tranche 2, and then same for tranche 3. That's clear. Now your total payment will be just the summation of these three, and this is the total principal payment. So once we have this, now we have plugged it in our debt schedule, which is just linked here, and your ending balance, everything moves accordingly. Now if you change anything here, if you change it to 2 years, it will still balance. Everything will shrink and everything will expand accordingly based on user's decision. 9, it moves across. So that's, I think, one of the best ways to model debt schedules in your financial models. And another one example I want to give, this is a very important and best practice from a corporate point of view, to have checks in your model. Wherever I have worked, I have always created checks in our financial models, and this is a very appreciated corporate practice because it gives comfort to you as the modeler, and it also gives comfort to your management who are looking at your financial models. So always create checks to ensure that your workings are correct. Now here my check is that my debt schedule has to balance at 0. If that doesn't happen, it means my debt schedule is incorrect. Let's move on to the third part, how this will impact the income statement, balance sheet and cash flow. So in an income statement, the only thing that would be coming will be the interest expense, which is just linked from here, the interest expense. Now your total net impact on the net income would be minus of this, which is captured here. On a balance sheet, if you see, in a balance sheet, cash will come to in just a few minutes. On the equity and liability side, your retained earnings will be impacted cumulatively, and which is done here with that impact on the net income. On the current borrowings part, you will have to reflect the next year's loan repayment, which you see is this. So for 2025, current part of the loan would be 1.2. For 2026, your current part of the loan would be 1.8, and so on. So this part we have linked, and in the form of non-current part, that would simply be your current year's ending balance minus the current part of the loan. And again, we have dragged this across. Now let's look at cash flow impact. So here, if you see, strictly from an IFRS point of view, in the cash flow from operations, when we start with the net income, we would add back the interest expense impact, which is accrued in the P&L, and then reduce the actual interest expenses paid by the firm in the cash flow from financing activity. So that's what is being done here. First, we have reflected the bank borrowings, which is the additional loan coming in, which is related to additions to loan, and this is dragged across. Then the second part is the debt repayments, which is the principal repayments that is being paid by the company, and the same is dragged across. And then thirdly, which I was talking about as interest expenses paid, which is here linked with the interest expense. Right now you would see that the interest expense accrued and paid is same, but actually in real practice this is not the case. So here interest expenses paid are linked with the above, and the same is dragged across. Now in terms of opening cash, we are starting with 0. Your net cash impact would only just be these 3 items, because this is just a presentation impact that we are doing it here. So this is the only your net cash impact that a firm would have in terms of bank borrowings that they get, the repayments that they make, and the interest expense that they have paid. And the same formula is dragged across. Now the ending cash would be opening plus net cash impact, and then the next year's opening is just previous year's ending, and the same is dragged across. So in the balance sheet side, your assets would just be linked with the net ending cash impact, and that's what is linked here. So now if you see, these totals should match. So this is 51.7, this is 51.7, this is 81.5, this is 81.5, this is 115, this is 99.5. So that means our balance sheet is matched, and this is the total impact across the 3 financial statements from the debt schedule. So that's how you build a dynamic debt schedule inside a financial model. The key point is that a debt schedule should not be hard-coded. It should respond promptly when assumptions change, whether that is the debt to assets ratio, or new borrowings, or repayment tenure, or interest rate, or even repayment methodology. And this is exactly how financial models are built in corporates. The debt schedule should calculate closing debt, interest expense, principal repayments, current and non-current borrowings, and then link cleanly into the income statement, balance sheet, and cash flow statement. So whenever you are building or reviewing a model, don't only check whether the debt schedule is producing numbers. Check whether the logic is flexible. Check whether the assumptions are clearly separated and the outputs are flowing correctly across the 3 financial statements. If you want to practice this debt schedule yourself, comment Excel below and I will share the template with you. And if you are learning practical financial modeling for corporate finance roles, consider subscribing. That's all for now. Thank you. I'll see you in the next video.